In the previous unit, we examined business income and business deductions. In this chapter, as well as chapter 8, we're going to look at the business treatment for the acquisition of property and the cost recovery deductions. Basically, the depreciation on the purchase of real property. We're going to look at which business expenses can be immediately deducted, which business expenses must be capitalized over multiple time years, the tax code treatment of depreciation, and the tax code treatment of other capitalized costs. So deductible expense, as we talked about in Chapter 6, refers to all ordinary and necessary expenses paid or incurred during the taxable year to carry on any trade or business. This includes routine operating expenses, regular and recurring costs that do not materially add to the value or useful life of an asset, de minimis items, and certain building improvements by qualifying small taxpayers. Expenses that have a longer lifetime must be capitalized, which is an accounting process whereby an expenditure is charged to a balance sheet account rather than immediately being deducted from the firm's income statement. This includes repairs that enhance or create a distinct asset, repairs intended to repurpose an asset for a new or different use, items that create a long-term benefit to the firm, as well as items that are ambiguous under the tax code. If there is any doubt, you should capitalize, not deduct, because the tax code is founded on conservatism. Other deductible expenses under the tax code include the first $15,000 of capital expenditures related to improving a building or improving transportation access for the elderly or infirmed, research and development expenditures, although this changed under the Tax Cuts and Job Creation Act of 2017, and advertising expenditures. Additionally, expenditures benefiting certain industries can also be deducted. For example, soil and water conservation costs can be deducted immediately, and oil and gas production costs can be deducted immediately, even if the wells additionally and in the future generate income. So what do we mean by capitalization? What are we capitalizing? What is the value that must be deducted over time? To start with, we must know the tax basis, which is the taxpayer's investment in any asset or property and the measure of unrecovered dollars represented by the asset. In other words, the amount of the expenditure that gets classified as an asset and then deducted over time. We record an asset at its initial cost, and by that we mean the price paid, including sales tax and incidental costs related to putting the asset into service. This can represent cash paid out of hand, but it can also represent an exchange of goods or services that's surrendered in order to acquire the asset, or the use of debt and cash financing to acquire the asset. Whatever the full exchange amount is to acquire the asset, that's the initial tax cost, the initial cost basis. At the end of the useful life of the asset, it will have undergone several deductions based on the tax-based treatment of depreciation. Now, it's important to note that for tax purposes, for book purposes, and for fair market value purposes, these are each different numbers. So let's check your comprehension. What would be the initial tax basis for Sugarista as she acquires each of these assets for her business? First, if she paid $12.50 for a commercial oven, sales tax on the purchase, and installation costs were $103 and $250 respectively. So we know, for tax purposes, that the initial cost basis refers to the full cost of putting an item into service. So therefore, she must include the $1,250 purchase price, the $103 tax, and the installation price when she records the initial cost basis of this item. Second, if Sugarista acquired a stainless steel preparation table in exchange for $750 of baking credit, the answer is $750, which is the fair market value of the exchange price, or the resources sacrificed to acquire the asset. Her initial financial statements would record the item at a $750 value. And finally, if Sugarista exchanged 400 shares of her business, valued at $5 per share, for a commercial fridge. In this case, the tax basis of the item is equal to the 400 shares times the fair market value of the shares, or $2,000. The initial basis is the fair market value of the assets exchanged. As we alluded to in the previous chapter, firms must use accrual accounting to record the cost of and the balance in inventory accounts. You may recall from your financial accounting class that cost of goods sold represents the value of inventory or merchandise that left the business through sales during the preceding year. You calculate this based on inventory at year start plus inventory purchased minus the inventory at year end. The inventory at year end is the amount carried forward on a capitalized asset account, and the value of inventory sold during the year is reported as the cost of goods sold. Now, for tax purposes, you must use UNICAP, which is the Uniform Capitalization Rules. Under such, this requires that you record as inventory not just the direct, indirect costs associated with the inventory processing, but also a portion of the executive team's salary, the pension, retirement, and employee benefits related to employee activities, the rents on the buildings and the equipment used in manufacturing, premiums on property insurance, repair and maintenance costs, and cost recovery, or that depreciation for the productive assets. This means that for tax purposes, your cost of goods sold will likely be higher than the cost of goods sold for reporting. As in financial accounting, you account for inventory using one of three specific methods. Specific identification, wherein you can track an inventory item from start to finish. This would be appropriate for the purchase of my Corvette, wherein each vehicle has a specific vehicle identification number, and a Chevrolet dealer can identify which Corvettes are still on the lot and which Corvettes have been sold during the period. However, for someone like my baker friend at Sugarista, or a manufacturing company that manufactures thousands of items that are homogeneous, it's a little bit more difficult to track when each item leaves the floor. This leaves two options: LIFO, or last in, first out, or FIFO, first in, first out. FIFO makes your financial statement income look better because the first in generally have a lower cost than the last items in and the last items out. However, During periods of inflation, LIFO has the most favorable effect on taxable income. The most recently acquired items have the highest costs, so this means that a firm reports lower income. However, LIFO is a little bit worse for the book perspective because the items that are recorded at a higher cost, which means lower income for book purposes. As far as the IRS is concerned, they don't care which method you use, as long as you consistently use a method for both book purposes and tax purposes. So let's practice our comprehension by looking at the cost of goods sold. And remember, for tax purposes, cost of goods sold is a little bit more inclusive. So, company XYZ manufactures a tangible product and sells the product at wholesale. In the first year of operations, the company manufactured 1,000 units, incurred $2,000 direct material and $130,000 direct labor costs, and they capitalized $85,000 of indirect costs to inventory. So for accounting purposes, the cost of goods sold are as follows. First, we record the total costs. Direct labor was $130,000, materials were $200,000, and overhead was $85,000, for a grand total of $415,000. If we manufactured 1,000 items, the per unit cost was then $415. We produced 1,000 units during the year and had 260 units left over at year end, which means that the firm sold 740 units. The cost of goods sold is then 740 times 415, or $307,100. Now let's look at cost of goods sold for tax purposes. For tax purposes, we must include this additional $116,000 of indirect costs, which means total manufacturing costs of $531,000. When we divide this by the number of units produced, we get $531 per unit, which we multiply by the 740 units sold, as we calculated before, for a tax purpose cost of goods sold of $392,940. In this case, we computed cost of goods sold without considering the inventory method. If we had an inventory method to consider, then we would have had to take into account the timing of production. But for this case, we're just using simple calculation. Just as inventory is subject to separate and more stringent requirements under IRS purposes than under generally acceptable accounting purposes, recording of depreciation on tangible assets is also subject to its own specific IRS requirements. This is called MACRS, the Modified Accelerated Cost Recovery System, which is the depreciation framework used for tax purposes. It represents a compromise between a company that wants to minimize the tax costs by deducting as much as they can as quickly as they can, and the IRS, who wants to make sure that the income tax situation reflects reality. It is important to here note as well that MACRS depreciation is not the same as book depreciation or the same as fair market value. These are each different numbers that each represent separate concepts. Now, the MACRS system is framed on three tenets. First, the recovery periods. MACRS assigns each tangible asset to a group, and each group has a specific recovery period. As a compromise between companies and the IRS, the recovery period, or the period on which you can run depreciation, is typically shorter than the asset's useful life, which means that companies get some acceleration benefits. The depreciation method. Under MACRS, the depreciation method is contingent upon what recovery period is used. Assets with a short lifespan, or in the 3, 5, 7, and 10-year recovery period groups, use double declining balance. Assets in the 10 and 15-year recovery period groups use 150% declining balance. And these long life assets, buildings, and permanent fixtures use straight line depreciation. When the amount that would be reached under double declining or 150% declining balance exceeds the amount that remains to be depreciated, MACRS requires that companies report straight line depreciation. And finally, the depreciation convention. This standardizes when the asset was put into service and when the asset was removed from service based on the purchase dates. This would only apply in the year that the item is put into service and the year that the item is removed from service. As I said, MACRS depreciation represents a different number than book depreciation and carrying value. Let's compute the difference by looking at my friend's bakery, Sugarista, comparing the difference between straight line depreciation and MACRS depreciation for her baking and kitchen equipment. The first thing to consider is how much are we depreciating. Under the straight line depreciation method for book purposes, we assume that the asset is going to be worth $2,500 at the end of its useful life. So our depreciable basis is $10,000. For MACRS purposes, there is no assumed residual value, so the amount to be depreciated is $1,500. For straight line depreciation, we would take the amount to be depreciated, or $10,000, divided by the number of months over which the item is to be depreciated, for a monthly depreciation amount of $83.33. Since in the first year of service, Sugarista used the asset for 10 months, from March 1st to December 31st, the total first year depreciation is $833. Now MACRS makes it a little bit easier because the life group, the method of depreciation, and the depreciation convention are each pretty standardized. They actually publish tables wherein they figure the monthly or yearly rates of depreciation. For 7-year class assets in the first year of operation, this is 14.59%, which takes into account the double declining balance that is used for 7-year life assets, as well as the half-year convention for new assets put into service. This means that for the first year of operation, Sugarista can take $1,824 of depreciation versus $833 that she would take under straight line method. In addition to capitalizing inventory and capitalizing long-term assets, a new business must also capitalize certain intangible assets that have a lifeline that can be determined. If the intangible asset does not have a lifetime that can be determined, then the asset value is merely written off at the end of the period that it's held. The book talks about 3 specific categories of intangible assets that must be amortized: organizational and startup costs, leasehold costs and improvement, and business acquisition intangibles. Let's look at these first. These business acquisition intangibles are normally called goodwill, which is the excess of a lump sum business purchase over the value of the acquired assets. When a company acquires another company, it assigns a value to each of the new assets acquired, and anything that's left over is goodwill. Any such goodwill amounts must be capitalized and then amortized over a 15-year period. Leasehold costs and improvements take on a life of their own. Any physical improvements to a lease must be capitalized to an asset account using the MACRS convention, even if the duration of the lease is shorter than the useful life of the new improvements. And finally, organizational and startup costs. These are the costs associated to starting a business, such as filing registration fees that are required under state and local law, as well as all the money that must go out the door before you can sell a single cookie, in Sugarista's case. For both of these categories, a new business can deduct their startup or organizational costs up to $5,000. Anything above this amount must be amortized. If the total costs to start up a business exceed $50,000, the benefit is phased out. You don't get to take the $5,000 deduction at all. Other amortizable intangibles include information-based intangibles, customer and supplier-based intangibles, such as non-compete agreements, patents, patterns, formulas, and other intellectual property, workforce intangibles, and non-compete contracts. So let's check your comprehension. How much startup costs can be amortized if Sugarista opened its doors on March 16th? If Sugarista's startup costs were $4,750, how much can she deduct? The answer is the whole balance. The annual startup cost is limited to $5,000, and her startup costs are below this threshold. Second, if Sugarista's startup costs were $27,320, she can deduct the same $5,000 that's allowed by law, and the remaining $22,320 must be capitalized over time. And finally, if Sugarista's startup costs were $53,120. In this case, her deduction benefit begins to phase out because her startup costs exceed $50,000. In this case, Sugarista's deduction is limited to $5,000 minus the difference between the threshold of $50,000 and her actual startup costs. This would be $3,120, which means that Sugarista can deduct $1,880 in current year's expenses. The remaining $51,240 must be capitalized. In this unit, we considered what is the taxable basis of an asset and how do you spread the cost of that asset across its useful life. In the next unit and the final unit of this course, we'll look at how you record the taxable benefit of an asset when you dispose of the asset.